President Trump are increasing tensions with two U.S. trade partners. As of today, 50% tariffs are officially in effect for Brazil.
Brazil, as an example, has been.
President Trump is using the economy as a political weapon. He's been saying that tariffs are about leveling the playing field.
About 40% of our coffee comes from Brazil.
We can't grow coffee here. There's only two states that can grow coffee, well, two places in the U.S. that grows coffee. One of them is our territory, Puerto Rico, and the other is Hawaii.
I wish that this wasn't happening, especially to small businesses at this time.
Then when you add tariffs, possibly, on top of that, then, your cup of coffee may double.
Imagine waking up to find your coffee damaged by a trade war. That may sound unlikely, but President Trump immediately boosted Brazilian coffee import tariffs by 50%. Brazilian coffee imports stopped overnight at U.S. ports, the world's largest coffee consumer. Reports say 50 bean-carrying vessels were denied in one night, shaking the industry. Brazil quickly signed billion-dollar contracts with overseas buyers, despite rising local pricing. The key question is, did Washington relinquish control of America's morning ritual to foreign markets by taking such a hard line with its main supplier? We'll discover how this bold move may have had unintended consequences as the story develops. Millions of Americans need coffee daily, making it more than a drink. From the first sluggish glass at daybreak to the mid-afternoon work boost, demand is high. The USDA estimates that Americans consume 24.5 million bags, or 10.8 pounds per person, yearly. That $3.72 billion company shows how firmly coffee is ingrained in American culture. Diners, gas stations, kitchens, and break rooms have it. Many include it in their morning ritual rather than as a treat. Due of location, the U.S. doesn't have the ideal environment to grow much coffee. Coffee plants thrive in tropical areas with constant rainfall and high elevations, which are rare on the continent. Hawaii and Puerto Rico are the only suitable locations for small experimental farms in Southern California. On the other hand, their total output is so minor that it cannot even come close to satisfying the need on a national scale. This is because their contribution is so insignificant. As a specialty bean, these beans are pricey and scarce in supermarkets. To sum up, America imports most of its coffee. This makes Brazil crucial. Over 30% of U.S. coffee imports come from the country. Nobody ships more than Colombia, the next largest provider, which ships less than a sixth. Thus, 1 in 3 American cups of coffee are manufactured from Brazilian beans. Brazil is the world's top coffee provider for a reason. Its broad growing regions, optimum climate, and over a century of experience. This allows the nation to supply a massive amount of beans at pricing American roasters and importers have counted on. Quality matters as much as quantity. In particular, Brazilian Arabica beans have gently changed American coffee taste. Their moderate flavor, consistency, and affordability make them the cornerstone of many mixes. They are neither extreme nor unique. Tim Hortons, Maxwell House, Starbucks, and Costco's Kirkland use Brazilian beans to balance their drinks. Smooth, familiar morning coffee is probably Brazil. Often overlooked, these beans comprise the fabric of American coffee. This great reliance on Brazil makes America's coffee supply chain more fragile than most people realize. Instead of increasing domestic productivity like manufactured goods, coffee has no quick fix. If Brazilian shipments slow, halt, or rise in price, supermarkets and coffee shops are affected instantly. For decades, American coffee culture has assumed plenty and affordability. Cheap cups are available at busy restaurants and gas stations. That expectation is nearly unattainable without Brazil's continuous flow. By mid-2025, American coffee lovers' long-term concern had become a reality. On August 1st, 2025, Washington imposed a 50% tariff on all Brazilian coffee imports, marking the tipping point. The sudden and extreme move disrupted the decades-long energy flow in American coffee shops and kitchens. President Trump justified the risky levy, which made coffee a pawn in a widening trade war, as an attempt to give American growers a fair shot. A beloved daily requirement entangled in economic policy was unprecedented. The world's largest coffee user and supply were matched overnight, with immediate effects. Brazil responded quickly. The next day, its president warned against American pressure. This was a firm declaration that Brazil will not back down. International traders and brokers instantly reevaluated their assumptions as long, stable coffee contracts became less reliable. Curiously, Brazil's stock and currency indices stayed constant, indicating investors believe the country could recover. Brazil said it has countermeasures, even if the U.S. launched first. The shocks were immediate. American importers quickly changed or ended long-standing contracts with Brazilian suppliers to locate beans abroad. Brazilian coffee exports to the U.S. decreased 18% in 1 week compared to last year. Buyers turned to Asia, Africa, and Central America for supplies, but they were scarce and expensive. Brazil still produced almost a third of the world's coffee. Thus, the shortage wasn't caused by supply. Price was the issue. The tariff eliminated Brazil's cost edge in the U.S., making its beans expensive for roasters used to low imports. Brazil quickly went from America's top supplier to an impossible sale. If Washington tried to force Brazil to concede, it failed. Brazil turned the crisis into an opportunity without giving in. New buyers rushed to buy Brazil's displaced coffee in days. China expedited import licenses for over 200 Brazilian coffee companies 3 days after the tariff was announced. Brazil gained a foothold in the fast-growing Chinese market. China, once a tea-drinking nation, has embraced coffee rapidly, especially in cafe-crazy Beijing and Shanghai. Brazil turned a U.S. trade penalty into growth, with direct access to over 1 billion consumers. Europe stepped in immediately. After quickly negotiating with a Brazilian coffee cooperative in Germany that supplied American roasters, Railway rerouted the beans to European retailers. America had lost stability, but the EU provided stable demand and no tariffs. Japan and South Korea also rushed to increase supply for their cafe cultures. Brazilian exporters rapidly realized that Washington's pressure had accidentally allowed them to diversify and improve their coffee market position. The effects were immediate and obvious throughout the U.S. Coffee drinkers felt the pinch after a few weeks. Ground coffee cost $7 per pound a few months ago. After the summer, that bag sold for over $8 nationwide and over $9 in affluent states like California and New York. Retail coffee prices rose 15 to 20% instantly. That meant an extra $50 to $100 per year for households that drank 2 pounds of coffee a month to maintain their caffeine habit. Such figures may not sound dire, but they were an additional burden for households already struggling with rising food and fuel prices. Coffee has long been one of the few minor pleasures people count on, regardless of the economic. It became a luxury, forcing many to rethink their schedules. Some saved their cafe visits for the weekends and switched to cheaper, less flavorful brands. As a simple daily routine became a fiscal decision, it changed. Industry sectors were affected differently. Big brands and chains offer a buffer that smaller enterprises lack. Tim Hortons, Dunkin', and Starbucks, with huge supply networks and long-term contracts, could weather the storm. Starbucks was expected to lose several $100 million in earnings, but its size and loyal customer base would allow it to recover. Drip coffee and latte prices increased by a few cents, but not significantly. These corporations saw the levy as an expensive inconvenience, not an existential danger. Tiny grocers and independent cafes were much worse off. They were surprised when wholesale bean prices rose 30 to 40% overnight due to their low margins. Few could handle such a rise. Many owners switched to cheaper beans from Ethiopia, Honduras, or Southeast Asian Robusta to adapt. The transition was challenging. Consumers used to Brazilian coffee's smooth, balanced taste noted the difference. It wasn't simply taste that changed little local cafes' identities and relationships with loyal customers. Stories like this spread nationwide. Due to higher prices, Ohio customers disliked a family-run store and switched brands. A small Kansas cafe had to cut hours after a tariff-induced blend change dropped sales by 20%. These little players suffered the most nationwide from an uncontrolled trade war. A modest Oregon cafe had to cut its pastry selection and lay off 2 workers to survive. When a popular Cuban-American cafe in Florida lost its Brazilian beans, its coffee lost flavor, and weekend traffic dropped. The cafe served thick espresso. These instances were part of a nationwide trend. Coffee shops are social hubs and enterprises. When a cherished local business closes, the area suffers. While Washington sacrificed coffee in the trade battle, Canada gently changed course. Ottawa's wartime neutrality saved it from public fighting and tariffs, which was a surprise strength. Canadian importers had no need to deviate as there were no trade restrictions. Really, they bought more. In 2024, Canada's Brazilian coffee imports rose over 7%, and when U.S. demand declined in 2025, Canadian consumers were well positioned to capitalize. As the world's largest coffee buyer, the U.S. failed. Canada became a trusted partner by avoiding drama. Brazil now saw Canada as its ideal customer because to its strong coffee culture, stable regulations, well-established retail chains, and low tariffs, Brazilian exporters and farmers found refuge in that mix at the opportune time. Analysts say Canada could get billion-dollar long-term contracts to guarantee supplies for years if it acted quickly to lock in contracts. Canada may surpass the U.S. as Brazil's biggest importer in a few months. America's calm northern neighbor was an important trading partner who could reshape North American coffee topography. Interestingly, Canadian clients barely noticed the disruption. Canadian prices stayed steady while New York and California prices rose past $9 per pound. Many coffee drinkers south of the border stuck with the same blends despite the unrest. That stability became a competitive advantage by assuring consumers, protecting neighborhood cafés, and strengthening Canada's reliability for Brazilian exporters. Example, Tim Hortons, the nation's most famous coffee shop, because it had consistent Brazilian beans and didn't have to worry about taxes. It kept its prices while its American competitors gradually raised theirs. Other Canadian roasters, big and small, profited. Some even increased American sales by allowing online orders. American shoppers were increasingly turning to Canadian websites for affordable, authentic coffee. Canada gained a unique economic advantage over its southern neighbor by doing almost nothing. Washington desperately sought beans from throughout the world, while Ottawa welcomed Brazil. This clever move boosted Canada's coffee trade ranking while hurting the U.S. Brazil had already transferred a large chunk of its future shipments to Canadian consumers before Washington policymakers learned of the situation. The upheaval affected global markets. New York Arabica futures rose over 30% by late July. Robusta prices in London rose almost 50% by August. Instant coffee's main ingredient, Robusta, was trading near $2 a pound, while Arabica beans were trading at $3.70, up from $2.80 in July. These numbers represented a major shift in the global coffee economy, not just trading screen numbers. The tariff shock increased importers' and consumers' costs worldwide. The surprise price spike gave Vietnamese and Colombian farmers and exporters a momentary boost, but also generated worry. If Washington could strike Brazil, why not target their crops next? The risk was scary. Coffee comes from Brazil, Vietnam, Colombia, and Ethiopia, accounting for 70%. High tariffs on even a handful of these key producers might collapse the global market. No straightforward alternatives for importers. Outside those top origins, there is inadequate capacity to cover the gap. You can't plant additional trees and expect rewards in a few months. Unlike oil or grain, coffee plants survive only in certain climates and take years to develop. Infrastructure for trade processing mills, storage facilities, and transportation routes takes time to rebuild. If several large suppliers close, the world would have much higher prices and fewer store options. Thanks for watching. Don't forget to like, subscribe, and share.